The broadcast is now starting. All
right now.
Hello, everybody. Welcome to the Bookselling University, course number 125, Tax Tips for Authors. I am your presenter, your leader today, Carol Topp. There is no webcam today for this webinar, but that's what I look like. I am a CPA, a certified public accountant, and I'm the author of 13 books. The one that probably applies to you as the audience today is a book I wrote called Business Tips and Taxes for Writers. And a lot of what I'm going to share with you today comes from that book, but more importantly, probably is my experience being the accountant for several authors and writers and even bloggers, those who are self-published as well as traditionally published. So you'll hear lots of different kinds of tax tips and maybe even a few real-life stories that might help you better understand the tax system here in the United States for writers and authors and self-publishers, and of course the professional experience and things as well. Here's what we're going to talk about in the next hour or so that we have together. We're going to talk about your business structure very briefly, because that affects what tax form you file. But no matter what tax form you file, much of this workshop will be very helpful and applicable to you. In another course number 124, called starting a publishing business, we talk a lot about the business structure and which one you might want to pick. So this will just be a very high-level view of business structures. Then we will talk about the famous tax form. You will get to know it quite well, the Schedule C, if you don't already, and we will go through it section by section. Talk about the very important, lovely thing called tax deductions that lower our taxes. Lots of tips sprinkled throughout, including some very helpful information about recent tax changes with the Tax Cut and Jobs Act passed late in 2017 by the United States Congress that you'll want to know about, that help you as a small business owner. And I think and I hope we'll have enough time to wrap up a short discussion about sales tax. So this will not be just about federal income tax. It will be a little bit about sales tax too, since we as writers and authors have to care a lot about sales tax. So let's get started with my explaining a little bit about the different types of business structures and how they're taxed, and so you know which business structure you are and therefore what tax form you file. There are three types of for-profit business structures in the United States. Sole proprietorship is by far the most popular. Probably 80% of small businesses are sole proprietorships, meaning they have one owner. I am a sole proprietorship. I'm the only owner of my business. It's like a single family house. That's easy to understand, right? One owner. The other type of business structure that is legal, permitted in the United States, is called a partnership. You could think of that as like a duplex, more than one owner in one business. They are taxed differently. It's a different tax form that you file. It's very rare to find authors be partnerships, legal business partnerships. You might have a business relationship with another author if you co-author a book or if you have an illustrator, but that's more of a business relationship, more of a contract, not a business set up as a legal partnership. Okay, in general, I don't really like my clients to be formed as partnerships. None of them are. I say being a partnership is like being married, but you're not in love. You are tied to that person. Your partner can go out and spend money like a drunken sailor, as my husband would say. They can spend money and you basically have no recourse. So you are really tied financially and legally to your partner, and that's why basically many CPAs really don't like their business clients to be in partnerships. I say you can be in a partnership if you are a lawyer, an accountant, or a doctor who hires a lawyer and accountant to help them understand the pros and cons of the partnership agreement. Okay, the final type of business structure you might be, and it's kind of rare for authors to be this too, is corporation. You could be two types of corporation, S Corp or C Corp. I talked in the other workshop, now course number 124, about setting up a publishing business, that publishers, small publishers, might set themselves up as S corporations, meaning small. Well, it's part of the IRS code, but I like to think of S corps as being small. They're limited in the number of shareholders they can have. But corporations are more like, to use the picture illustration here, more like an apartment building, many owners. They're called shareholders, okay? Like an apartment building has many people living in it. For this workshop on taxes for authors and writers, we're going to focus on the sole proprietorship, because that's what 80, 90, maybe more % of you as authors and writers will be filing your taxes as sole proprietorships. One owner in your writing business, you. If you have formed a legal partnership, you will be, you better be, using a CPA, using a tax professional. Do not prepare that partnership tax return yourself. It's called a 1065. It's complex. You've got to make sure you're doing it right. Or if you have formed as an S corporation or a C corporation, those are the larger corporations, C corporations, you better also have a CPA and an attorney to advise you about that. And you will be filing what's called a Form 1120. They are expensive tax returns to file. This is why you will be paying your CPA upwards of $400 or $500 and up for either the partnership or corporation tax returns. There are some tax benefits. I don't think we're going to have time to talk about that for S corporation, but that's, again, usually only if you are publishing other people or something like that. We're going to focus on sole proprietorships. You probably have heard of this business structure called LLC. It stands for Limited Liability Company Status. It's actually not a tax status. It's a legal status in your state, and it limits the liability, meaning potential lawsuit or money from a lawsuit, to your business, so that someone who sues your business can't get your personal assets, your retirement, kids' college, savings accounts, whatever. My sole proprietorship is an LLC. I added this status by filing some paperwork in my state. So if you sue me or someone sues me, you can only get the assets that will be limited to my business assets, which is the money in my business checking account. You can't get my personal assets. So I am what's called a single member LLC, because there's only one member, one owner of my LLC, me, the sole proprietorship. I'm just telling you that because people get kind of confused. Like I'll talk to them and they'll say, well, how is your business set up? And I'm fully expecting them to say sole proprietorship, because like I said, 80, 90% of authors are sole proprietorships. And they'll say things like, well, I'm an LLC. Well, that's not what I asked, because I'm talking about tax structures. So you are not taxed any differently when you add LLC status to your sole proprietorship. Okay? You're not taxed any differently. You're still going to file the same tax reform that you did before you had LLC status. But it's definitely something you might want to look at if you were concerned about potential liability, lawsuits or damages and things like that. And I discussed when you might want to think about adding LLC status in my book, Business Tips and Taxes for Writers. So since this is a workshop on taxes and not an LLC status is not a tax status, I'm giving you that brief overview, and we're going to move on. We're going to move on to the nuts and bolts of what our hour spent here in this course is today, and that is filling out this tax form. It's called Schedule C. Here's what it looks like. Oh, in all its glory. I spend a lot of time with Schedule Cs, and I know you guys hate them because you are word people. You are not number people, and this form looks horrible, doesn't it? It is like the IRS forms at its worst. Okay, but we will take it in bits and pieces. This is the form. It's called Profit or Loss from Business for Sole Proprietorships. You see that right at the top. It's the title of the form. It is part of your 1040. So it says right there at the top, attached to your 1040. And this is where you tell the IRS, here's the money I brought in for my business. Here are the expenses of my business. Here's my profit. The profit goes on the front page of your 1040, becomes part of your adjusted gross income. All right. So, like I said, you're going to, I want you to be familiar with this form. even if you use a tax professional to help you prepare it, you will be a better client because you have gotten familiar with this form. You will be in a better working relationship. I almost said partnership, didn't I? A better working relationship with your tax professional, your CPA, because you took this class and you understand better this form. My best clients, my favorite type of client is someone who has prepared their own income tax and just comes now because they want another set of eyes, or their taxes are getting more complicated. But those are the best tax clients because they have gotten familiar with income, expenses, they understand. And at the end of this course, you will understand a whole lot more as well. All right, let me start with the very beginning, the very top of this tax form. It's the Schedule C. It's pretty straightforward. You can fill in the name of your business, the name of the proprietor, that's you, your social security number, or you can give them your employee identification number if you've applied for that. I talked about that in the other workshop about setting up your publishing business. But there's this one box here, box B, where the arrow's pointing, kind of stumps people. What code? What code do I put in there? Well, the IRS uses a system, an identification code to identify businesses. And here are three possibilities of what you might be. An independent artist, writer, performer. That might fit you guys. Then you'll use the 711510 number. Or maybe you're publishing. You actually are a publishing company, meaning you're publishing yourself and others. That's what the IRS means there. You might use 511000. Or then this new category got created called Internet Publishing and Broadcasting. That's kind of for bloggers or podcasts. Now and that would be 513130. You know, you have to figure out what you are. We can certainly do a consultation about it to figure out what's the best code here. It doesn't make you pay different taxes if you pick a different code. All the IRS is trying to do is say, gosh, if you're an independent artist or writer, I expect to see certain kind of expenses. So the rest of your Schedule C should kind of match what you're putting in there as a code. That makes sense? And so just a way for them to say, does what you tell me you do kind of match what kind of expenses you're showing me down below? That's the point of this business code. And they also track things, you know, what industries are thriving and happening and profitable, and which ones are dying and changing and things like that. The rest of the questions there have to do with accounting method, probably your cash-based. I talk about more cash, which is when you receive the money, you record it. Accrual is a more complicated accounting system. Talk to your tax professional about which one you're using. Chances are you're using cash. Accrual would be is if you are billing people, but you're recording the money that you earned, even though you didn't receive it yet. A lot more complicated. 99% of taxpayers are cash-based, like our personal lives are cash-based. We record money as when we get the cash in our hands. The rest of the form is pretty straightforward, simple questions that they're asking here. Line I, let me talk about that. Did you make payments that would require you to file a 1099? 1099, you're probably familiar with getting this form. This is the form you get if you're an independent contractor and you have earned money. It's called the 1099 miscellaneous. But if you pay somebody, I'm going to talk about this a little bit later, but if you pay somebody like your editor, an illustrator, somebody like that, more than $600 a year, you're supposed to give them a 1099. And that's what that question is asking. Did you give anybody 1099? Okay, so answer that correctly. Did you or did you not? The part of the Schedule C that we care most about is the tax deductions. All right. Well, let me back up. First of all, I didn't really focus on it, but the income part of the return is part one there. 99% you're going to fill in line 1, gross receipts or sales. You're probably going to fill in line 4, cost of goods sold. We're going to talk about that in a little bit. And then you just add the 2, line 7. That's probably what most of the tax returns you file are going to look like. Okay. You basically put all your income, gross receipts or sales in line 1. That's it. All right. Sum it all together. But let's talk about the part of the tax return that is much more complicated, and that is part 2, your expenses. Now, you guys got to understand that the IRS uses one form, the Schedule C, for every type of sole proprietorship out there. you know, for the dog groomer and the baker and, you know, the author and the accountant, right? So there will be many lines on this form that don't apply to you, all right? But some will apply to you. And sometimes you don't know, well, what expenses go in what category and what, you know, what does this thing mean? And it's a tax form, which is why you're taking this class, to get help from somebody who has taken classes and getting licensed to practice before the IRS and things like that. We will talk about the most common types of expenses that authors have, and then where they go in the tax return. I think it's a really good idea for you to be familiar with this part of the tax form, because you will then do your record keeping based on these categories, you know. So separate your, for example, line 8 there, advertising, right? And keep track of what is my advertising expenses. And I've got some tools to help you do that, okay? A spreadsheet. But, you know, split that out from, say, your line 25, your utilities, which might be your cell phone and internet use, because it makes your tax preparation so much easier if you use the categories that the IRS uses. And again, you won't use them all, okay? But that's what it looks like, and different lines go on different lines have different totals. Typically for an author, I would see maybe 5 of these categories be used. That's probably about it, about 5, maybe 6 of them. So let's go ahead and look at what very common expenses, and these track back to the Schedule C. All right, advertising I already told you about. This is where you put any, and of course ads you take out. If you are publishing or printing up brochures or postcards, I do, you know, business cards. I throw in my website fees. You know, we all pay money every year to have a website. I also have an email list. I use Aweber, so I put those fees. I consider that all advertising. It's all getting out information about my business. That's advertising, and I put all those expenses on the tax form under advertising. Mileage. When you're driving around for business purposes, you have to keep track of the miles. You have to keep a log. Keep track of the miles you drove, the date, and where you went, and the purpose of the trip. So I have a tendency to use my calendar and then a spreadsheet or a list of where I went, what day I went, what was the purpose, and what were the miles. I like using Google Maps to figure out mileage, but that goes under the line item called car expenses. Your mileage goes there, okay? A very typical expense for an author would be office expenses, right? Paper, pens. Some of you might be using also different kinds of software packages to help you write, edit different kinds of apps, things like that. Consider those like office supplies, if you will, even though they're software, they're not tangible. But that's where I would put, if you bought Scrivener or something like that, put those kinds of software packages or applications under office expenses. That's a line item on the Schedule C. Let's see, it is line 18. They're in the second column at the top. Travel. If you travel, I have several authors who are traveling. They're going to conferences. They're going to conferences to speak or conferences to sell their books. You can take the airfare or the car rental or your mileage to get there. You can deduct the hotel expense, and you can deduct half of the meals that you have when you are away from your tax home overnight. All right, so it certainly pays to keep track of those expenses. These are only for your expenses. If your spouse or someone, if your spouse goes along, their expenses are not deductible, although you don't have to split the hotel room down the difference, thankfully, or the car rental. You know, if you need it for your business purposes, you can deduct it. But your spouse's airfare obviously would not be tax deductible as your business expense. You know, we use our cell phones and we use our internet, and we can deduct those. You have to prorate them, meaning, you know, take only the portion of the cell phone and the internet that you use for business. Now, fortunately, the IRS does not ask us to keep logs of these. Whew, mileage, you must keep a log. But your cell phone use, no, we don't have to keep track of how many minutes we used for business, thankfully. Oh my goodness. Or the internet, we don't. The IRS says use any reasonable method to allocate business and personal use. So most of my clients will say, Carol, I use my cell phone 50% of the time for business, or I use it 10% of the time for business. Okay, then let's take 10% of your cell phone bill for the year, right? Same with their internet. I kind of will ask them, well, how many people in the family? You know, if there are 4 people in the family, maybe 25% of the internet use is your business use. And they'll say, oh, no, 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 I'm the one who's on the internet all the time. My kids, my husband, whatever, I never are. And then I'm like, okay, well, let's put you down at 50 or 75% of the internet. Any reasonable allocation method is what the IRS says. You put this, there's no line item that says cell phone, no line item that says internet. I put them under utilities. They're utilities in our day and age, right? Utilities is more than gas and electricity. It's cell phone and internet, line 25. These last 3 categories, professional development, book publishing expenses, and research, there's no line items for those. So, but they're very common and legitimate business expenses for authors. So you would probably put them on the other category, and I'll show you in a minute what that looks like. But professional development could be going to writers' conferences, could be online courses like this. Yeah, this is tax deductible, what you paid for this. Put it down as professional development, education if you want to. Expenses you might have for book publishing might be things like, okay, I hired an editor. Now, that editor maybe should be paid as a contractor. Remember, I talked about the 1099 miscellaneous, any contractors that you hire out. So actually, that editor's expense might go under the line item called contract labor. I'll talk about that more in a minute. But see, contract labor is their line 11. So anybody you pay as contractors, independent contractors, you would put in line 11, even if what they're doing is helping you get your book published. Get that? So you got to think like the IRS, folks, when you fill this form out. Where would the IRS put this expense? If you're paying independent contractors, put it on line 11. But say you're ordering, proof copies. Well, where does that go? This form is not designed for authors. Nowhere does it say proof copies. Okay, line 27, other expenses. Probably where you're going to put anything you can't find a place for. Okay. Research. So if you have to do some research, one of my clients writes Sherlock Holmes-like books. He went to London. He went to London to meet with his publisher and to do some research. Fun trip, right? But he wasn't allowed to deduct the part of the trip that was for pleasure or the part of the trip that was his wife's expenses. But his research was, meaning if you're buying books to do research, list those on your tax return. If you, have a trip, you wouldn't necessarily put it as research. You would put it there underneath the category called travel. But anyway, these are some other things that you have to, again, think like the IRS. Try to figure out where in that form you can put your expenses. If you're not sure, I've got some help for you, okay? Let me show you. I'm going to scroll ahead here a little bit. There we go. I've got an ebook for you called Tax Deductions for Writers, right? On my website, taxesforwriters.com. You can fill in your name, email, and you get emailed back this book that I have written with a lot more detail about what tax deductions writers can take, all right? So, or you can email me. If it's quick, I will answer it, or I will point you to somewhere on my blog called taxesforwriters.com, where I've answered it before, so you could go there. Or if it's more complex and you want to have a phone consultation, we would set that up. Okay, so that is where, make sure, okay, this was our list of common expenses for writers, right? I think I left off contract labor. I apologize, I should have put that in, but we'll get another slide on that. These are common expenses for writers, and they go on that middle part of the Schedule C. The back page, or page 2 rather, of the Schedule C asks for information on your vehicle, Part 4, and Part 5, other expenses. So this information on your vehicle, look at that for a minute. That's quite a bit of information. It takes 1, 2, 3, 4, 5 lines. When did you put your vehicle in service? I don't know. Yeah, when did you start? Well, the first time you took a trip, the first time you drove, put that down. And that will stay forevermore while you have that car, okay? Then you have to keep track of the total miles that you drove during the year. Business miles, commuting miles, and other miles. Commuting is when you're going to your day job. You know, it's not deductible. For the most part, I fill in, my clients will give me their business miles. I'll put an estimate of what I think it takes them to commute and personal mileage. It does not affect the tax return. I don't quite know why the IRS asks it, because all we can deduct is our business mileage. We cannot deduct our personal or our commuting miles. And then they ask, was your vehicle available for use during off-duty hours? Probably. Yeah, right. Do you have another vehicle for personal use? Maybe, maybe not. Answer yes or no, truthfully. Okay, line 47, look at that. Do you have evidence to support your deduction, and is it written? Now, mine is a spreadsheet, but I can print it out, make it written. You better answer those questions yes, because you have to have a log, and it better be written or reproduced in some form, and keep it up every year. They don't let you go back in history and create it. Keep it up. Part 5, the other expenses, this on the, again, the second page of the Schedule C, this is where you would list things like my research expenses, publications, meaning, you know, what magazines, if you subscribe to Writer's Digest, put it there. Dues, maybe you belong to some sorts of professional societies or conferences that you went to, and you put the conference fee here. This is the leftover stuff. I don't get too detailed here. I try to lump things into big categories for my clients. You know, professional development could be lots of things included in there. Many of my clients, being authors, they will have a category called books, books, because they're buying books to read to make them better authors. Let me explain. When you are deducting these expenses, the IRS says they should be ordinary and necessary. Ordinary, very common to your business. Necessary, meaning related to the business. And here's what I encourage you to think about. When you're spending money on your business, think of how this money will ultimately allow you to make more money. If that expense allows you to make more money, then chances are it probably is a legitimate business expense and therefore tax deductible by the IRS. Okay. I want to explain another big category of expense called cost of goods sold. Now this one is kind of funky. I'm going to back up a little bit and show it to you on the Schedule C. So it's not here on Part 2, expenses. It's actually on Part 1. Part 1, income, line 4, cost of goods sold, and then they say go to line 42. So the IRS in all its wisdom is following some accounting procedures here, okay? But your cost of goods sold is actually a business expense. Kind of weird that it's located under the income category, right? But this is accounting for you. It makes sense to us, but not to non-accountants. So I want to point out that cost of goods sold there on Roman numeral Part 1, income line 4, is actually when you buy inventory to resell, and you can deduct the cost of those goods as you sell them. So let me give you flesh this out a little bit more. So you buy 100 books of your inventory, and over a period of years you hope to sell them. You cannot deduct the cost of that inventory in the year that you paid for it. Normally we can do that with every other expense. If I buy a computer, I can deduct it in the year I bought it, even though I might use it for several years. Not so with inventory. You can only deduct the books as you sell them, and it's called cost of goods sold. So if you don't sell some books, you never get to deduct them. So be careful, folks, and not buying too much inventory. That's the rule of thumb here. So cost of goods sold is actually a calculation, and it is in Part 3 of the Schedule C. All right, look at more lines and more questions, and what you have to do, folks, in order to figure out your cost of goods sold is keep track of two things. Line 36, purchases. How much inventory did you buy in a year of your own books that you're going to resell? That should be pretty easy for you to find out, right? Because you paid either the printer or you paid your publisher to buy the books from them, all right? So your purchases. The next few lines may or may not apply. Cost of labor, for a little while, I did have a warehouse. They were storing things, pick and pack, when an order came in and I'd say, could you pack these 100 books and send them to this school, that kind of thing. Okay, I could put cost of labor there, but usually the bills just came all inclusive from this warehouse that housed my books. So I was putting it under line 39, other costs of goods sold. This was the cost to sell the book, okay, buy each book. Does that make sense? Line 38, materials and supplies. Well, when I ship my own books out, I got to pay for, the envelopes, right? Those are materials and supplies of selling that book. So I keep track of what I paid to buy the book. If I bought any extra materials to send it out, I can put it there. Sometimes, folks, though, you buy like 100 envelopes at once, and you want to keep track of what each costs to send out. Now, I kind of sometimes throw this in office supplies, to be perfectly honest. But then the other most important thing you need to keep track of, besides what you paid to buy the inventory, is line 41. How much inventory is left at the end of the year? Meaning, guys, you got to count your inventory near the end of the year. And then you have to know what you paid to buy each book and value the inventory that way. Got that? So if you sell 3 different books, you tell your tax professional, I had, so many copies of book A, book C, book B, A, B, C, and book A cost me when I bought it. Not what you can sell it for, folks. Cost me when I bought it $2.25. Book B cost me so much. So they will help you figure out what the dollar amount of your inventory at the end of the year is. And that number goes into this calculation of cost of goods sold. You basically calculate or back into what the costs of the goods sold are. If everything you purchased, you also sold in the year, your inventory is 0, cost of goods sold is everything you bought. That rarely happens. Never's happened, as far as I know, in all my clients' experience and my own. I buy inventory. I don't sell it all in the year. I have some inventory sitting in my house or in a warehouse on December 31st, and I have to have a count of that inventory. Yuck, right? I know you're not numbered people, but this is very important for tax purposes. You have to do it to get the best, tax deduction. If you don't calculate it, you don't get a tax deduction for the cost of the inventory that you bought. Because remember, you can't deduct it all in the year you bought it. Sorry, it's just accounting rules that the IRS follows. Okay, oops, sorry, too far. Okay, one other deduction that's really not in that same block of part of the Schedule C. It's not in that same block of expenses, is the business use of your home. This is actually down near the bottom of the Schedule C, line 30, because you can only deduct business use of your home if you have profit. So what the IRS makes you do is say, tell me what your income is, tell me what your cost of goods sold, that's your first deduction, tell me what your other expenses are, sum them up as your other deduction, do you have a profit? If you have a profit, I'll let you maybe take business use of the home. So the business use of the home can be taken if you have a part of your home that you have set aside for regular use in your business, and here's the kicker, folks, exclusive use, only for business. Meaning, if it's used by the family, if that computer is sitting there on a desk and you do your writing at that desk, if it's also the place where the kids do their homework, or you're managing, your recipes on Pinterest like I do, or you're using it for personal email and stuff like that, it's not exclusive use, folks. You cannot take the home business deduction. So my home office, I'm speaking to you today from an extra bedroom in my house, and for the whole time my kids were living at home and growing up, I never took the home business deduction or business use of the home deduction, because it was, this office I'm sitting in now was not exclusively used for business. The whole family used it. After the kids moved out, went off to college, this office is only used for business. Now, My husband steps in it occasionally, but rarely. He has his own computer in the basement if he wants to send an email. That's what exclusive use means, folks, okay? And a couple years ago, the IRS simplified the method, thankfully, to calculate business use of the home. Now they're just using $1 per square foot, $5 per square foot. So one time you measure the dimensions of the room or the partial room. If you only use part of a room, just take that part of the room for exclusive, that you use exclusively for business, part of the room, multiply it times $5. There's a maximum $1,500 deduction. So all of my clients are now using this simplified method. I am too. I ran my, being a CPA, I ran the numbers both ways using the longer form and the short form. And my total deduction was like $850. It was only like a $10 difference. So this IRS system, the simplified method, works very well. I love it. Again, it goes on the Schedule C near the bottom of the form. So deduct it. It's fabulous. And anyway, I just love the simplified method. We don't have to mess with figuring out, the depreciation on the house and other stuff we CPAs used to have to do. And we charge you guys more for filling out that business use of the home form. And now I don't charge my clients more because there's no separate form. It's just $5 per square foot. Little inside tip there. Okay, one of the last expenses I want to talk about, I touched on earlier, contract labor. This was on part 2 of the expenses on your Schedule C. And I touched on it that if you hire an independent contractor like an editor, web designer, maybe a bookkeeper, maybe an illustrator, maybe even your CPA, right? And you pay them more than $600 in a calendar year, you have to give them this form 1099 miscellaneous. And those 1099 miscellaneous is that you report, or and anybody that you paid but didn't meet the $600 threshold, you pay them less than $600, add all those up, put them on line 11, contract labor. Okay, so you can deduct any and all people that you pay, even if they don't get that 1099 miscellaneous from you. That's what I'm trying to say. Now, don't fill this out on paper, folks, okay? The reason is you can't print out this form from the IRS website. They use special red ink like the picture there, and your printer does not make the right color red ink. Sorry, so you have to either order the forms from the IRS, irs.gov, 1099 miscellaneous, and a cover sheet called a 1096. Or you can go to an office supply store, typically in January and February, or December. They start in December because these are due to your independent contractors January 31st. So you got to fill them out during January. I prefer online. I don't want to wait for the IRS to get me order forms. I don't want to give, Staples or the office supply store $25 when I only have to fill out 2 of these, right? I use a service. There's plenty of them online, but I use one called Yearly, Yearli. Cute spelling, yearly.com. There's also like file 1099, file taxes online, all kinds of different services that will do this. So you type in the information from your independent contractor, their legal name, address, their EIN or social security number, and what you paid them. And for less than $5, like $4.95 or something like that, Yearly will mail them a copy, send a copy electronically to the IRS, and you get to keep a copy. It's lovely, fast, beautiful, okay? But this is how you pay your independent contractors when you paid them more than $600 a year. You must file a 1099 miscellaneous and give it to them. If you don't, the penalties are quite severe. So please obey the law, guys, and give those 1099s. I mentioned before, but I'll reiterate, there's a lot more to learn about expenses and what is legitimate and what is not. We just don't have the time because we got a lot more to talk about taxes to go over details about what's deductible and what's not. You probably have questions about that. So I'd recommend you go to taxesforwriters.com, download the ebook I offer you there for free, or buy my book called Business Tips and Taxes for Writers. I'll give you the information at the end of this course for just more information about all these things that I've touched on. The point, of course, in a short course like this is just to make you aware. Did you know about business use of the home? Did you know about keeping a mileage log? Did you know about contract labor? Now you do. so you can go and delve into it a little bit more with a little more reading. Okay, I'm going to share some tax tips next. First, I need to take a drink of water. Now, I've been talking to you about the federal income tax, folks, that you file on Schedule C, part of your 1040 tax return. There's another tax. You're not going to like this, folks. You're not going to like it at all. I'm not talking about federal income tax now. Now I'm talking about self-employment tax. I call it the hidden tax because it catches you by surprise. It's kind of hidden on the tax return. This is page 2 of the 1040, and I know you guys hate to look at these forms, okay? Look at all this gobbledygook, right? Words you don't understand, IRS forms you don't understand, lines you don't understand, but I want you to zero in on where the arrow is pointing. Under other taxes, this very innocuous looking little statement, line 57, self-employment tax, attached Schedule SE. Now, folks, if you're using software or tax professional, and I really hope you use a tax professional, they will fill in this self-employment tax here for you. The software will fill it in. If you fill out a Schedule C properly and put your income and expenses, it will automatically fill in the Schedule SE, that stands for self-employment tax, and add the tax, the self-employment tax there on line 57. And it's a shocker because all we think about is federal income tax, which is up there on line 44. See line 44, how it's in bold? Tax, this is the tax you owe. Take a look at that, folks. Very few people look at the true tax, line 44. They always like to look at the refund, right? Look at the tax you owe. And, you know, maybe you'll vote differently in the fall. But anyway, line 44 is federal income tax. Line 57 is self-employment tax. As a sole proprietor, as a business, you owe both those taxes on the same profit. Ouch. Ouch. So let me tell you, this is what self-employment tax is: Social Security and Medicare taxes for self-employed individuals. It's both halves of Social Security and Medicare. You probably know, if you've ever had a W-2 job, a job where you got a W-2, that some Social Security and Medicare were withheld from your paycheck. And what was invisible to you, though, was that your employer was matching that amount out of his profits, okay? When you have no employer, when you're self-employed, you have to pay both of those halves. Those halves are 15.3% of your profit from your Schedule C, all right? And it is calculated on this rather simple tax form. I know you guys don't like looking at these things, so nothing simple, but it's called the Schedule SE. And again, it's most of the time just automatically generated by your tax software or your tax professional. Okay, so 15.3% of your profit, folks, meaning you're paying federal income tax on your profit to begin with. And now the tax brackets have changed, but for the most part, for most of us, it's still 15% federal income tax, and then you're paying another 15% of your profit on your self-employment tax. And so what catches people by surprise is this self-employment tax. So my conclusion is, and this is what I tell my clients, folks, you need to set aside 25 to 30% of your profit every year just to pay taxes. Federal income tax, I haven't even touched on state tax. If you live in a high state tax, you better be saving more like the 30% of your profit and the self-employment tax. You've got those 3 taxes all on your profit. So set aside 30%. So I have one client, she is not a self-publisher, so she doesn't have a whole lot of expenses. She's traditionally published. So her royalties come to her on a 1099 miscellaneous and her book advances. And she puts that in one line of her tax return. And then she really does not have many other expenses, folks. She really doesn't. She hires me. She can deduct that. She travels a wee bit, mileage. That's about it. You know, tiny, maybe a little bit of office supplies, but not much, okay? So anyway, she and I sit down and she asked, Carol, what percentage of my royalty check should I put aside? She set up a savings account. She gets a royalty check, she scrapes off 30%, puts it in her savings account, and knows that has to be paid in taxes. And then she makes estimated tax payments every quarter. And she uses this system, lovely system. Ours just came up with a few 2 years ago, I think, called directpay.gov. This is what it looks like. I put a picture there because I want you guys to see what it looks like so you know when you're on the official IRS website. It will say IRS in blue at the top. Go only to directpay.gov. You tell them how much you want to pay, and you can either enter, I believe, a credit card. I always enter my checking account information, and it's an electronic payment system, and it's wonderful. It's worked. I've not heard any complaints or any data breaches. So it is a nice, easy way to make your payments to the IRS of that 30% of your profit, folks. Your profit is a little harder to calculate if you are, having expenses, if you are self-publishing and have lots of expenses like me. So I have a tendency to do kind of like an estimate at the beginning of the year of what I think my income and expenses are based on the prior year, and I make quarterly payments into the IRS. They want their money all year long, folks. You need to make those estimated payments. Yuck. Okay. Hey, but good news. Okay, enough of all that bad news. Yuck. I told you the bad news about, self-employment tax. I told you the bad news about how much money you got to set aside to pay these taxes. How about some good news? Okay, here's the good news. We get a tax break in 2018. The Tax Cut and Jobs Act that was passed late in 2017 changed taxes a lot on our personal side, which I'm not going to touch on because we're here to talk about taxes for you and your business side. But it gave a lot of tax breaks to corporations, and so that things were not unequal, there was also added to this tax cut something you may not have heard about, but something called a qualified business income deduction. Okay, this is for the sole proprietorships and other businesses that is a 20% of your profit tax deduction. Yay for businesses. Now, there are some restrictions, and it can be kind of complex if you have employees and if you're an S Corp. We CPAs are still figuring it out because it's really complex. But for most of us meaning if your total income, taxable income, is less than $157,000 as an individual, folks, that's most of us, or $315,000 as a married couple, you have a simpler calculation if you just take 20% of your profit and you get to deduct it from your federal income tax. Can't deduct it from that horrible self-employment tax, but hey, federal income tax, I'll take what I can get, right? So I want you to know about this. I don't have a form to show you. I don't know what the IRS is still working out the forms. They're still even kind of clarifying some of the code because it got kind of confusing. I took an hour-long, maybe it was, an hour-long class on it. My brain hurt at the end of it. But for most of us, it's going to, if we're underneath those dollar thresholds, 157,000 individual, 315,000 married couple, then it's simple. We just get to take 20% of our profit and deduct it from our federal income tax. Good news, right, folks? Yay, good news. Whew. I just want you to know about that. So this will probably be on page 2 of the 1040, and there will probably be a separate schedule that has to be filled out that your software and our CPA will help you complete. But make sure that it's there, when you're filing that 2018 tax return, 2018 and beyond, that tax return, say, where's my deduction for that qualified business income that lady was telling us about, okay? Make sure you look at it, appreciate it, savor it, because, we don't get many tax breaks for just being small businesses, but this is a great one. So wanted to let you know about that. And maybe that means a little bit less, definitely means a little bit less in federal income tax you have to pay, so maybe you don't have to keep setting aside that 30%, right? Folks set aside at least 20 or 25% of your profit to pay income tax, though. If you're using a professional tax preparer, they should be giving you an estimate of what the next year might look like and how much you should be setting aside, and then, of course, like I said, making your estimated payments. and they will take into consideration this qualified business income deduction, the QBI. Can't wait. All right, now, another tip I have, outside of knowing about, this new tax break and things like that. I know record keeping is really important, guys. I've already emphasized to you the importance of keeping a log for your mileage, keeping track of, what you pay your independent contractors. I created a spreadsheet for you to help you out, because I know you don't like keeping track of this, and you got to do better than just, receipts in a shoebox. So I created this spreadsheet because I had a tax client who was, she's not a numbers person, God bless her, and I said, let me make you a spreadsheet, and then I put it on my website. So you can find this spreadsheet over at taxesforwriters.com, and my clients now use this. None of them are complicated enough that they want to use software, but this spreadsheet helps them a lot. It has tabs for every month where they're recording in columns, what did I spend on advertising, or what did I spend on books, or you can change the names of the columns if you like to match you guys, but it also has places for you to record your mileage and record your inventory purchases. So if you keep track on this spreadsheet, don't mess with the spreadsheet too much, because there are automatic formulas in there, okay? I gotta tell one of my clients he was doing it wrong. Don't touch that column. That flows to the next spreadsheet. But it will summarize it on the top here, and this is something you could take to your accountant, or better yet, send them the spreadsheet that you filled in and been using all year long, and they will thank you because you just made their tax preparation easier. And then you hopefully we'll see that in the fee you pay. Okay, so that's a free spreadsheet over at taxesforwriters.com. Excuse me, I'm going to take a little water break and a little cough. I'm getting over a sinus infection, but you can read these tips, and then I'll be right back in 10 seconds. Okay, my last tax tips that I like to remind my clients about is that the IRS does not email, they do not text, they do not use electronic communication to communicate with taxpayers. They send letters, and only after probably 2 letters or more would they ever make a phone call. All right, so if you get a phone call from the IRS and you've not received a letter preceding it, chances are it's a scam. Hang up, and there's some information. Start Googling. I'll put some information over at taxesforwriters.com. How to report an IRS scam. They are out there. I get them. I get email scams. I know they're not from the IRS because the IRS does not email. I get a newsletter from the IRS because I signed up for it, but the IRS does not email individual tax clients. So if you get an email saying this is from the IRS, if you get a phone call from the IRS and hadn't received the letter first, it's a scam, ignore it. All right, delete it, delete, hang up. My second tip is software can lie to you. Software is only as good, tax preparation software is only as good as the user, right? So I was at a tax conference, and this attendee said, it was a writers conference. I was there speaking about taxes for writers. And this attendee said to me, the IRS did away with the home business deduction. And I thought, no, they didn't. I would know. That's a big deduction for small business clients. No, they didn't. And she said, well, my software didn't ask me the questions about it, so I just assumed they did away with it. Software can lie to you, ma'am, meaning somewhere in the interview process of these tax preparation softwares, you didn't click the right box, you missed the question, you got distracted, I don't know what, all right? But software is only as good as the user in this case. So, be aware of that, folks. And you're doing the right thing right now by attending this class and getting educated, all right? If something comes up and you thought, how come they didn't ask me about the home office deduction? Where's my $5 per square foot? Google, did the IRS do away with the home office deduction? No? Well, figure out where in your tax software you missed answering that interview question, all right? I really recommend, if you are doing your own tax returns, at least every 3 years, go get it checked by a CPA. All right, go to them in the off season. Please do not go to them during tax season. Go to them in the off season and say, would you look at my tax returns for the last 2 years or so? See if I'm doing it right. Can I have a half an hour of your time? I'll pay you for it, right? Because you can go back and amend your tax return for up to 3 years. Which is why I say get it checked at least every 3 years. It's kind of like a tune-up on your car, right? They'll probably tell you, you didn't know about this new tax deduction, right? Or you didn't know you were eligible for that. Or I think you're putting things in the wrong place, and that could trigger an audit by the IRS. You know, we're here to help folks, so please use our services. You know, you may not want to hire a CPA every year, and get that. They can get kind of expensive, but at least get somebody to look it over every 3 years to see if you're making any mistakes. Okay. I think we have enough time to blast through sales tax. I already talked to you about federal income tax. That's the biggie, right? The self-employment tax, that's the horrible one. And sales tax, oh, that's horrible. But not a biggie, and it's frustrating because we're collecting sales tax on the behalf of states and sending it to them. We are basically like, you know, tax revenue agents collecting the state's taxes for them and not getting any compensation, and it's a headache. So let me explain. When you sell a product, your books, even ebooks, to people within your own state, you must charge them sales tax because you have what's called nexus, a physical presence in your state. If you sit in your state, and I'm sitting here today in Cincinnati, Ohio, my home, and I'm just shipping books to clients in other states, I do not have to charge them Ohio sales tax, you know, to a customer, say, one in Texas that I'm shipping a book to, because I have no nexus, no physical presence in Texas. All right? So there are a few other people. You don't have to collect sales tax on out-of-state sales. You do not have to collect sales tax when you sell to resellers. You only collect sales tax when you are selling your product to the final purchaser. That makes sense? The final customer. So when you sell to booksellers or the middleman or something like that, you don't charge sales tax to them. Also, you may not charge sales tax to nonprofits that might buy your books, including schools. That varies by state, so you have to check out the state laws, to know if nonprofits, usually the nonprofit knows, oh yes, we have sales tax exemption in our state. When, as a nonprofit, when I buy things, I don't have to pay sales tax. They will tell you, usually, okay? But the headache is really the out of state. Now, if you travel out of state, then you have created a physical presence in that state, and you must collect and remit sales tax to that state. So I traveled to Texas from my home in Ohio, physically in Texas at a conference selling books. I had to collect Texas sales tax and remit it to the Texas Department of Revenue. I had to get what's called a transient vendor's license for those Texas sales. In Texas, you register online. Many states you register online. Some just have you fill out a simple form at the end of the event, send in the sales tax within 10 days or something like that. But Texas was kind of annoying, to be honest. Sometimes you have to pay for these vendor licenses. You register online and have to pay for the privilege of collecting the sales tax for that state. And then Texas required, I think it was, I can't remember now if it was quarterly or twice a year. They required you to file a sales tax return even if you hadn't entered the state and even if you had no sales. So I was late filing my Texas sales tax return. I had no sales. I had not entered the state all year long, and they fined me $50 for being late. So I'm not very happy with Texas right now. This is the difficulty of going to other states to sell your products, folks. I got to let you know about that. Right now, electronic sales, you know, when I sit in Ohio and the customer buys it electronically, I've not entered the state of Texas, I don't charge them sales tax. That's the rule right now. There is a court case before the Supreme Court, which may or may not change that. Probably, hopefully, won't change that unless you're a big seller. And big seller, jeeps, that varies by state. We're a complicated system, and sales tax is complicated. So there are some websites to help you. I'll give you that in a minute, but I do want to also point out that digital products, ebooks, digital downloads, music, are taxable in about half the states right now. Here's a picture of the states that have sales tax on digital products. So when I sell my ebooks to Ohio customers, I have to charge Ohio sales tax. Okay, fortunately, the services that I use, including PayPal, I've set PayPal up to add sales tax to Ohio customers. And I use another service called ClickBank for my ebooks. I have set them up to, they collect and remit the sales tax for me. So there are nice ways to, you know, Amazon collects and remits the sales tax for you. There's nice ways to do it. Sales tax gets complex when you're selling your own books directly to the last purchaser, and it gets real complicated when you're going into other states. Just warning you about that, folks, okay? Sales tax is a headache, real headache. What's not a headache is getting some help, okay? Oh, I meant to tell you there are two websites that I use to help me track and understand sales tax. I didn't put this on the slide, I apologize, so I'll tell you now. One is called taxjar.com, TAXJAR.com, TaxJar. They're wonderful about giving information about what's sales taxable in what states. And then the other one is called Avalara, Avalara, just like it sounds, a bunch of A's.com. They are a service, accounting service that helps people pay and manage their sales tax. And they just publish very helpful information about sales tax, especially on digital products. Okay, my book, I've mentioned it a couple times, and my website, taxesforwriters.com. In my book, I do touch on sales tax. Obviously, I talk about a whole lot of other stuff like hobby. I didn't even talk about hobby income. I figured if you're paying for this course, you're not a hobby writer. You are a business owner. And so I talk about business structures, which was covered in more depth in the other course, 124, on setting up a publishing business. Talk about the finances, the financial planning. Talk, of course, a lot about taxes in that book, record keeping tips, dealing with inventory, which we only touched on a little bit with, when I was talking about cost of goods sold at the beginning. But inventory is really important for you to track, not just to know if you're being successful, which books are selling, what is not, but, for tax purposes, got to manage our inventory well, which is easy to do now, right? That we have print on demand and things like that. And finally, sales tax. Like I said, big headache when we don't get any compensation for doing the state's work. So can you tell that's a pet peeve? Yeah. I hope the book is helpful. This has been a very quick workshop to cover a lot of ground. I hope this was helpful for you to see what that Schedule C looks like, to know what things you can deduct, to know what the importance of what kind of records you need to keep. But if you need more information, there's my website and my email. Carol Top is my name. Taxes for Writers is the website. I do phone consultations. I don't do much tax preparation for people outside of the local area, which I'm in Cincinnati, Ohio. But if you're an author in Cincinnati, Ohio, I will take you on as a tax client, but I'm not taking new ones right now. Not from out of state. I encourage you to use local tax preparers. They know your state laws best. But I do enjoy phone consultations, more about your business structure, things like that. And I really enjoy visiting writers groups. So if you belong to a writers group or a conference, a writers conference, I will be, I frequently attend the Midwest Writers Workshop in Muncie, Indiana, the last couple of years. And this year, I think I am speaking at the Kentucky Writers Conference. I think I've also spoken at some of the writers conferences in Indiana and stuff. Anyway, I enjoy speaking at writers conferences. But if you're far away from Cincinnati, Ohio, we can do a virtual visit. I've done those with writers groups, and they're a lot of fun too. So find some more information on taxesforwriters.com or my Facebook page called the longer version of the book, Business Tips and Taxes for Writers. I want to commend you for getting educated about your business, understanding about taxes. I apologize if I've not answered your specific question, because I bet there's a bunch out there. When I've done other webinars like this, they usually go for 90 minutes because there's so many questions. But you can hopefully find those on my website or in the book. And if it's not covered, then email me. Frequently, if I can answer it quickly, I do. If it involves longer, I warn you. And, there's usually some small fee for email questions or phone consultations. But it's better to do that, to pay a small fee to get the answer for your specific question rather than make a mistake and have the IRS contact you. We do not want that, folks. Okay, so I wish you the best in your endeavors. You know, keep legal, keep good records, and get it checked occasionally by a CPA, or go to a CPA yourself to get the best information on your business.